Hello everyone, this is Scott Bear here at Mortgage Pro. I am part of your real estate success team here at Realty Pro, and I'm here to make you successful. Now we've noticed a little bit of an uptick in rates as of late. We've had a lot of volatility abroad, Egypt, some inflation fears in the Eurozone, and we've had some very conflicting jobs report information that came out today as well, which we'll get into here momentarily. The 30-year fixed rate, 5%. 15-year, 4.25. 5/1 ARM is at 3.625. 7/1 ARM is at 4.25. FHA and VA are both at 4.75, and USDA is at 4.875. Now the rates obviously are just a little bit higher. Jobs reports came in, and it was a little bit weird. We had 163,000 jobs that were expected to have been created in the private sector, and it only came in at 50,000. So that was rather disappointing as far as jobs was concerned. That would have typically helped mortgage bond pricing, though. But the conflicting information that also came out simultaneously was very weird. The unemployment rate went from 9.4 down to 9%. Totally took everybody by off guard. And upon a little bit further investigation, the outstanding or the total official labor force contracted by about 504,000. So I can guarantee you that those people didn't go out and just find a job. They probably left the official labor force because of discouragement at not being able to find a job. So these pieces of data are in conflict with one another, and it's confusing. And typically traders, when there's confusion, they sell now and ask questions later. So that's pretty much what took place, and the rates have gone up in the past several days as a result. Now, along with this email, I've also included the spreadsheet that I had mentioned on Tuesday. Very useful data, helps you forecast different purchase prices at various interest rates over time. Very useful. And I've also included the timelines for derogatory credit entries on your credit report, foreclosures, short sales, bankruptcies, that kind of thing. Now keep in mind with these timelines, with Fannie Mae, these timelines are the minimum timelines that they will buy loans on the secondary mortgage market. Most likely these timelines are the minimum timelines, and there will be overlays at various lenders. So those timelines will only be that and worse. So keep that in mind. These are the minimum timelines, very possibly worse. Now let's get into the spreadsheet and go over that a little bit briefly. Hello everyone, here is your new spreadsheet for your own personal Realty Pro agent use. Please do not broadcast this anywhere else. This is just for Realty Pro agent use. Very powerful tool. You'll be able to use this in your listing appointments as well as your buyer's agent appointments especially. This will help people get off the fence, and rather than waiting because they think the purchase prices are going to go down over time because of continued depreciation, they should be buying now because of interest rate increases over time. And I'll go through this here very shortly. So let's do a conventional scenario, for example. Let's do a down payment of 10%. Now anything in yellow you can alter. Anything that's not in yellow you will not be able to alter. So this gives you a lot of very good data. 30-year term. Let's say interest rates fluctuate over time from 5% to 6%, and we'll keep the same purchase price fluctuations from $25,000 increments clear up to $350,000. So what we'll be able to say is that at 5% right now, you will be able to afford a $1,200 payment, principal and interest, at a $250,000 sales price. Now, if over time, let's say a year, the interest rates go from 5 to 6%, your purchase price power will be able will be affected essentially. So you'll go from 250,000 down to 223,843. That's about a $27,000 difference in purchase power. Now, very useful tool here. If you think that the depreciation rate over this period of time is going to be less than what is indicated on this sheet, say the 10.5, let's say it's going to be half that, then your new purchase price at the same payment, your new purchase price is going to be that much higher because of less depreciation, which means that waiting because of depreciation, thinking that you're going to get and be able to afford more house, is not going to be the case, because your purchase price is going to be that much higher, and your interest rate is going to be that much higher as well over time, based upon your assumptions. So very powerful tool, allows people to see that, look, you do not want to wait because you're going to be able to afford that less of a house because of the higher interest rates. And you can do the reverse. You could say the interest rates went down from 6% to 5%. You can make the same type of determinations. You can look at this depreciation appreciation figure and say, do I think that over this time period that I've picked that the appreciation is actually going to be 11%? If it's not, then you can make determinations about the new sales price at the same payment and say, hey, we need to wait, or we need to move ahead and buy because of the fluctuations in interest that we are figuring may happen. So very powerful tool. Gets buyers off the fence and gets them to see that waiting is not the thing to do, especially at rises in interest rate. So use this at your leisure. Use it in your appointments. Let's make some more transactions and get buyers and sellers off the fence and make them understand that waiting is not the thing to do nowadays. So have at it. Have a great weekend. If you've got any questions regarding this forum, please don't hesitate to give me a call. And like I say, this is for real estate Realty Pro agent use only, exclusively. So thank you so much, and we'll talk to you soon. Bye-bye.